Welcome along, Investorholics and friends. Today we're going to take a bit further of a deeper dive into the mega global oil glut, investment opportunity or not. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances. Expand your investment horizons and crack your financial sky. So taking a look at the graph here on the right hand side, we can see that in late April, the West Texas Intermediate Crude Futures crashed below zero. So the United States is swimming in oil. If you're left holding the nearest term futures contracts at expiration, you are forced to take delivery of the oil. Those taking delivery of physical oil would face very expensive storage costs because, as we've kind of seen on the news and the rest of it, pretty much there's no storage anywhere, or even all the empty tankers are full up. So you've got to actually pay through the nose to store it somewhere. So traders were prepared to pay buyers to take delivery of the oil. While the supply glut remains, there is a risk that the current near-term June contract price could also go negative as it approaches expiry, so towards the end of this month as well. Negative oil futures price is due to the way that the oil futures market functions, the fact that the May oil futures contract were due to expire the following day. COVID-19 has also got a controlling hand in suppressing demand for oil, and the price war between OPEC plus, which are the key players in contributing to the massive oil price fall. So as we all know, we're definitely living in unique times and circumstances, and that's created some interesting factors that has created the oil shock at the moment. Price shock anyway. So the Saudis and Russians didn't agree to significant production cuts, and that's flooded the market. So subsequently to that, they actually have tried to make an agreement, but I don't think that's actually going to stick. So the world engaged in COVID-19 induced lockdowns, significantly reducing demand. So pretty much supply went up and demand came down all at the same time, made the futures contracts worthless. Sustainability of US shale is in question. The current oil crisis has created several major problems for the marginal producer in the US shale oil patch. So pretty much they've actually capped the price that they take effectively. To keep producing, shale producers need to constantly finance and drill new wells. So shale producers are already losing money at these price levels, and funding operations much longer looks unlikely. So research firm Rayson Energy predicts up to 533 bankruptcies by the end of next year, especially if the prices stay below $20, or on average $20 anyway. So there's definitely a possible upside for the big oil companies. So previously the new entrants cut into the majors' market share, and because there was so much supply, they put a ceiling on the oil price. Cost cutting and improving conventional deep water projects effectively strengthen the majors' balance sheets, which now allows them to operate at a lower oil price. So, you know, silver lining, I suppose you could say. So there's some forecasts that suggest that the major companies could withstand 2 years of oil prices below $40. You know, that's remained to be seen, but pretty much in the short term, it's put a cap on their prices, their earnings. In the long run, it could actually be quite good for the big companies. So as with all these things, market turmoil, you know, you're likely to see a lot of consolidation, especially the best assets into the major companies, and the lower performing ones will just get spat out, and other companies will try to do the best with those ones that they can for the time being. So consolidation could potentially leave the likes of BHP, Exxon, Chevron, Total with greater market share in the long run, and also they'll have all the higher quality assets potentially as they come out of the downturn as well. So a quick summary. So OPEC Plus cuts not sufficient to offset the current glut in oil caused by the lack of demand. So I even heard today before I recorded this that those negotiations don't look like they're actually sticking. So whether it's the Saudis or the Russians, they're still pumping out a lot of oil. The major oil companies may dominate the space soon due to limited access to capital and the potential for bankruptcies of the smaller to medium players in the industry. So I suppose the whole reason we're doing this is looking for investment opportunities. So my main focus here is on ETFs. So let's have a look what we've got. So, I suppose the big question is, at current market levels, is this an attractive entry point? So the current circumstances are creating extreme conditions in the oil market futures. In my opinion, that's not good. Holding these positions are very expensive for investors. This is due to the futures curve being steep at the front end of the contract. Let's take a quick overview of the BetaShares crude oil ETF currency hedge. I'll have had a deeper dive into this one. I'll put the card up in the right hand corner if you want to go back to that video and have a look at that one. As I mentioned, it's one that trades the futures. It's essential to understand the concept of futures contango and how this affects return over time. So this is a concept that I had to go and research because it's a bit, I suppose, complicated or something that's not natural for most people to understand. So contango or backwardization, okay, get that word out, are terms used to define the structure of the forward curve. So I didn't have time to get the graph, but if you're interested in looking at this, just Google it and you'll be able to see the curve. So when the market is in contango, the forward price of the futures contract is higher than the spot price. Conversely, when the market is in a backwardation, the forward price of the futures contract is lower than the spot price, if that makes sense anyway. So the oil price futures contract is not the same as the spot price of oil, as we kind of touched on. So you're trading the futures here, not the spot price, and that'll give you a different outcome. So triple O, you definitely need to proceed with some caution. Typically, this one trades the near-term futures of the West Texas Intermediary crude. However, since the turbulence of last month, BetaShares have attempted to reduce the risk associated with this product. So they've shifted exposure to the longer dated September contract for the time being. So pretty much the feeling is that those longer dated contracts will actually have a bit more stability. Just the sheer fact that there's just no storage and you don't want to be taking delivery of that oil. So if you have that contract, you're obligated to take delivery of the oil. So by having the longer dated contracts, hopefully you get a better price when you're trading on to the next month, because you're still 2 or 3 months out for actually having to take delivery of that oil. Other investment opportunities. This one probably, I've reviewed this one as well. I'll chuck the card up in the right hand corner. So BetaShares Global Energy ETF, currency hedged once again, allows investors to take a long-term view on the oil, and just the fact that it's cyclical recovery, it's just cyclical by nature, the supply and demand type thing. The index has historically had a relatively high correlation to the oil price, so we're looking at sort of an 84% correlation monthly returns to the Brent crude oil US dollar per barrel since the end of 2018. Take that with a grain of salt. So this one has pretty much directly invests in oil companies, producers, bigger companies that exclude Australia. So looking at the 50 biggest energy companies in the world, or for a better word, they like to call them the super majors. So they currently take up 46% of Fuel's portfolio. That was at the end of April anyway, mid to April. There's a bit of a breakdown there. So the fund is hedged to minimize the effect of currency fluctuations in portfolio performance. So I reckon this one is actually probably a better one if you're taking a long-term view, and safety-wise, your money is probably better invested in this one, just the sheer fact that there's actually some underlying businesses there. So you can actually sit down and do some basic work on how these companies, these bigger companies, are actually going to come through the downturn. The oil glut, we've already seen like Chevron and a few other companies reducing their output, just effectively leaving the oil in the ground and trying to help stabilize the prices. But sort of as we sort of went over before, I think there's definitely going to be a lot of bankruptcies and a lot of consolidation in the industry, and I think that'll actually give these bigger companies more market share and more profits in the future. So probably, you know, for a more conservative investor, maybe something worth looking at. Fuel. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.